Hello everyone, today I'm going to solve some sample questions from your chapter 20 aggregate demand, aggregate supply model. Let's start with the first question. The long run aggregate supply curve shifts right if which one of these changes. So just remember how long run supply curve shifts. So we have two supply curves. If you read the chapter carefully, you'll understand that one is short run supply curve and the other one is long run supply curve. So the long run supply curve is vertical. We have price level here. This is the general price level and that represents the prices of the final goods like consumer price index, CPI or GDP deflator. And we have here real GDP. And in aggregate demand, aggregate supply curve, there is one here, Yn, which represents the potential output. Potential output is the output level that the economy uses all of the resources it has. So it reaches the full capacity. And at that output level, we have the natural rate of unemployment. Natural rate of unemployment. And let's say this is our aggregate supply curve. It's vertical. And then we have short run supply curve, and then we have aggregate demand. So in the long run, all are at equilibrium at Yn, and the economy reaches its potential. So now we need to find out how we can shift this long run aggregate supply curve. As you see from the figure, long run aggregate supply curve does not have an impact because of an increase in prices. Whatever the price level is, long run aggregate supply curve stays the same and the economy produces the output Yn. But long run aggregate supply curve can shift to the right or to the left depending on the events happening in the economy. And long run aggregate supply, remember this is the total production in the economy. It can change because of, first of all, labor. If you have more people to work for, then the aggregate supply curve is going to shift to the right, and right represents an increase. And then what else we have? Capital stock. If you have more physical capital than or human capital, then long run aggregate supply curve shift to the right. And another one is KH and technology. If you have an advanced technology, the workers become more productive. Therefore, aggregate supply curve shifts to the right. So for that reason, the right answer is this one. All of the above are correct. Let's do the second question. If the economy repeals an investment tax credit and increases income taxes. So what is the scenario here? We have now taxes are higher. So remember, people are paying tax, so they receive after income tax to spend over the month. For that reason, we need to find out what happens if tax credit is repealed and income taxes are increasing. And this is going to affect the consumption. Why? Because if you pay more tax, you have less after-tax income. Therefore, you need to reduce consumption. And aggregate demand has four components: consumption spending, investment spending, government spending, and net exports. And therefore consumption is going to go down. When the consumption goes down, aggregate demand curve is going to shift to the left. Remember, shifting to the left represents a decrease in aggregate demand. If that is the case, look what happens. This is short run aggregate supply, this is aggregate demand, and their intersection now is at a different point with a lower output. Therefore, real GDP is going to fall. And price levels are going to fall as well. For that reason, the right answer is real GDP and price level fall, which is D. Number 3, from 2006 to 2008, there was a dramatic fall in the price of houses. If this fall made people less wealthy, so we're talking about here wealth, and we know that wealth is related to household. If people that their wealth is going down in value, they are going to spend less, and therefore this is going to affect the aggregate demand curve, and aggregate demand curve is going to shift to the left. Remember, left represents a decrease in aggregate demand curve. Next question, if money is neutral, so let's remember what money neutrality says. Money neutrality says that real variables like real GDP, real wage, does not have an impact if you change the amount of money. Why is the case? If you change the money supply, let's say Fed prints money and increases the amount of money, prices are going to rise at the same level. Therefore, for instance, let's think about the real wage definition. Real wage is nominal wage divided by prices. So nominal wage is going to increase because of the money supply. Prices will increase, and therefore real wage doesn't change. So if you want to explain this in plain English, it says that when the prices are higher because of the increase in money supply, people will demand more wages. Yes, they will earn more wages, but their purchasing power, which is the real wage, is not going to change, because you will see both high income and high prices in the economy. So with the high income, you purchase the same number of goods in a month. Therefore, neutrality of money says that the quantity of money do not affect real output. So that is the right answer. Next question. From 1995 to 1999, there was a dramatic rise in stock prices. If this rise made people wealthier, then it would have shifted. So the common mistake that students make when they answer this question is that since stock price is related to businesses, they will think about supply side, but it's not correct. Remember, aggregate demand represents expenses, and also investment is an expense too. But this rise in stock prices is not even going to have an impact on investment. It will affect the consumption. Why? Because buying stocks and bonds were considered as saving in economics. Therefore, when the stock price rises, consumers feel wealthier, and therefore they will increase their consumption. When they increase their consumption, aggregate demand curve is going to shift to the right. So this is the right answer. Next question. During the last half of 2012, the US unemployment rate was just under 8%. Historical experience suggests that this is actually 8% is above the natural rate, because US has natural rate of 46%. And if that is the case, remember, YN, the potential GDP, represents 4 to 6% unemployment rate. Any unemployment higher than that represents lower production. Therefore, real GDP growth was likely low. So it's above, this unemployment rate is above the natural rate, and real GDP growth was likely low. Question 7. The aggregate demand and aggregate supply graph has, so this is important, please make sure that you know what are these terms. When you look at here, on aggregate demand, aggregate supply curve, P is on the vertical axis and it represents the price level, general price level in the economy. And on the horizontal axis, you have the real GDP or output. So we need to find out the right answer. The price level on the vertical axis is correct, and the price level can be measured by the GDP deflator, that is correct too. Price level could be CPI or GDP deflator. Both are price indices that represents the overall prices in the economy. Therefore, the right answer is C. Next question. Other things the same, aggregate quantity of goods demanded in US increases if, so we need to find the situation where AD curve shifts. Okay, so remember, AD curve, aggregate demand curve, has 4 components: consumption, investment, government spending, and NX. Anything that affects these 4 components will have an impact on AD. So let's see the answers. If the interest rate rises, investment becomes tough. Why? Because the cost of borrowing increases. Therefore, investment projects could be stopped. And that's not the correct answer. If the dollar appreciates, then the domestic products are expensive. Therefore, we are going to sell less products to foreigners. Therefore, NX is going to go down. That's not the right answer too. Real wealth rises. If the real wealth rises, the consumption component of aggregate demand curve is going to increase. Therefore, AD curve is going to shift to the right, or aggregate demand is going to increase. So right answer is A. Next question. If the economy starts at A, here we are on this point A, and there is a fall in aggregate demand, the economy moves where in the long run? So this is a good question. Let's draw the curves first. So we have what here? We have the price level, and we have the GDP, and we have long run curve, aggregate supply curve. We have short run aggregate supply curve, and then we have aggregate demand curve. So what happens in this economy? We know that the aggregate demand curve falls, so therefore aggregate demand curve is going to shift here. This is the new aggregate demand curve. And now we are at point D. We were at A, now we are point at D. So what is going to happen in this economy? First of all, people were expecting the price level to be at A, but then turns out to be prices are lower at D, so at D prices are lower. So therefore people are going to modify their expectations, and when they make their wage contracts, now they are going to ask for lower wages because of the situation in the economy. Now we have a recession. This is the potential output, and the economy is producing lower than that. And overall prices are going to go down. When prices are going to go down, it should be less costly for businesses to produce more. Therefore, short-run aggregate supply curve is going to shift to the right. So this is the new aggregate supply curve. So what happens? First we started with A. There is a fall in aggregate demand curve, and people realize that prices are going down because of recession and there is low production. Therefore, the new wages and the prices in the economy adjust to a lower wage. When this happens, short-run aggregate supply curve shifts to the right. Why? Because it becomes more profitable to produce or less costly to produce. Therefore, the new equilibrium in the long run is point C. So the right answer is to C in the long run. Next question, aggregate demand shifts right when the government does which of the following? Now let's remember again, aggregate demand is consumption plus investment plus government expenditure plus net export. So we need to find a situation that one of these components increases. If government spends more money, expenditures are increases, or demand for goods and services increases, AD increases. But decreasing the tax is not going to make that happen. Expenditure cut is not going to make that happen. Repealing an investment tax credit will reduce the investment, therefore is not going to increase aggregate demand curve. Therefore, the right answer is none of the above. Question 11. So we are given again short run and long run aggregate demand, aggregate supply curves. This is ADS model. Suppose the economy starts where long run aggregate supply curve is equal to AD1 is equal to short run aggregate supply curve 1. So let's draw the curve here to answer this question. So we have here again prices, and this is my long run aggregate supply curve, and then here you have one AD1, and then you have one short run SRAS1, and also you have AD2, and you have short run aggregate supply curve 2, short run AS2. We are starting here. Long run aggregate supply equals AD1 equals SRAS1. A decrease in short run aggregate supply would be consistent with the movement of what? So if there is a decrease in short run aggregate supply curve, then short run aggregate supply curve is going to shift like this, okay, to the left. Left represents a decrease. And then what happens? If that is the case, now let's write out the prices. This price is P3, this price is P1, and these prices are P2. And if that is happen, if the aggregate supply curve shifts to the left, the new price is going to be this one. Why? Because this is going to be the new curve, intersects with the previous AD1. AD1 doesn't shift. The only thing that shifts in this graph is short run aggregate supply curve. Therefore, the price level is going to be P2, and the corresponding output to this price level is in the figure Y1. So the right answer is P2 and Y1. Next question. other things the same. When the price level falls, interest rates. So let's understand this. If the price levels fall, then what happens? People demand less money. So demand for money goes down. When people demand less money, interest rates are going down. If the interest rates are going down, then people invest more. Why? Because borrowing now is cheap. So therefore investment increases. So the right answer is fall. So firms increase investment. A decrease in US interest rates leads to what? If there is a decrease in the US interest rates, remember the NCO. Okay, NCO says that the first term is domestic residents are buying foreign assets, and the second term is foreigners buying domestic assets. So if there is a decrease in the interest rate, US assets returns are going down. Therefore, foreigners are going to buy less domestic asset. This is going to go down. If this is going to go down, we know that you're subtracting a smaller number from the first component, and NCO is going to go up. If NCO is going to go up, remember that NCO is equal to net exports. This is an accounting identity. If NCO goes up, net exports is going to go up. So therefore, we are going to see for sure a greater net exports. And now let's also think about what happens to the exports and imports. So let's think about the foreign exchange market. In the foreign exchange market, if you remember that when NCO shifts to the right, remember this is foreign exchange market. This is again from chapter 19. This is the exchange rate. And now we have net exports here, and NCO is the supply. So therefore, if NCO shifts this direction, then we know that there is going to be a depreciation of dollar. So the depreciation of dollar and greater net export. So let's review what we have learned here. So when the interest rates are lower, the demand for US assets are going to go down. Okay. And if that is the case, people demand for less dollar. They do not want to get dollar because they don't want to buy US assets. Therefore, exchange rate depreciates. When exchange rate depreciates, remember from net exports, the first component is exports. Exports are going to increase. When exports are going to increase, net exports are going to increase. So the dollar depreciates, and then we have higher net exports. Question number 14. The sticky wedge theory of short-run aggregate supply curve says that when the price level is lower than expected, so the price level, actual level, is lower than expected price level. So prices are decreasing. Then, relative to prices, wages are higher and unemployment rise. So wage contracts are based on expected price. Therefore, wages are going to be higher relative to prices. And if that is the case, companies are going to lay off workers. Why? Because they are earning this actual price, but they are paying wages based on expected prices. And at the end, the right answer is relative to prices, wages are higher and unemployment rises. Question 15. Most economists believe that in the long run, changes in the money supply does not affect the real variables. Okay, that's what I explained in the previous question. And does change nominal variables. So it's going to be affect nominal, but not real. This view that money is ultimately neutral is consistent with classical theory. Classical economist always says that money is neutral in the long run. Question 16. Suppose that banks are less able to raise funds, so lend less. Consequently, because people and households are less able to borrow, they spend less at any given price level than they would otherwise. So therefore, consumption goes down. This crisis is persistent, so lending should remain depressed for some time. What happened to the price level and real GDP in the short run? So here we can analyze this on aggregate demand, aggregate supply model. This is aggregate supply, this is aggregate demand. Since this is a short run evaluation, I don't need to draw long run aggregate supply curve. And what happens that people and households borrow less money. And if they borrow less, then they are going to spend less. Both consumption and investment going to go down. And therefore, aggregate demand curve is going to shift to the left. This is the new aggregate demand curve. And then we have a new price level and a new real GDP, which is lower than the previous price and previous GDP. Both the price level and real GDP false is the correct answer. So these are the questions that I've selected for you for chapter 20. If you have any questions, please let me know.